So you're a landlord in Singapore. That's fantastic. You're enjoying that rental income. But then tax time rolls around and suddenly you're wondering, am I leaving money on the table? Or even worse, am I about to make a really expensive mistake? Well, today we're going to break down all the essential rules so you can get this stuff right. Renting out your property is a great move, no doubt about it. But when tax season hits, that little question starts nagging at you, right? Am I reporting this correctly? Am I paying more than I have to? Let's clear up all that confusion right now. All right, first things first, let's get the absolute baseline straight. In Singapore, the tax authority, IRAS, is super clear on this. Every single dollar you make from rent is taxable income. No ifs, ands, or buts. So step one is just knowing that it all has to be declared. But here's where it gets interesting. This isn't just about reporting the total rent you collect. The real challenge and the opportunity is figuring out your actual taxable income after you subtract all your costs. And that's where you've got some pretty important decisions to make. Okay, so let's define what IRAS calls gross rent. Just think of it as one big pot that holds everything. It's the money for the apartment itself, of course, but it also includes any extra cash you get for furniture and even maintenance fees if your tenant pays those directly to you. It all goes into the pot. Now, here's maybe the most important point of all. You don't pay tax on that whole pot. Your real mission is to figure out your net rental income. And the formula is as simple as it gets. It's your gross rent minus all of your legally allowable expenses. That final smaller number, that's what you're actually taxed on. And that brings us to the first major decision you have to make as a landlord. When it's time to subtract those expenses, IRAS basically gives you a fork in the road. You can go one of two ways, and the path you choose is going to directly affect your paperwork and, more importantly, how much tax you actually pay. So here are your two options. On one side, you've got path 1, claiming your actual expenses. This is for the detail-oriented folks, the ones who don't mind keeping meticulous records. On the other side is path 2, the shortcut, the 15% deemed expense method. This one is all about convenience. It's simple, it's straightforward, and you don't have to hoard a shoebox full of receipts. Let's walk down path 1 first. This is the traditional way of doing things, where you carefully track and claim every single dollar you actually spend to keep your rental property running. So what exactly counts as an actual expense? Well, as you can see, the list is pretty long. You've got the obvious stuff like property tax and fire insurance, but here's a big one. You can deduct the interest you pay on your mortgage. That can be a huge chunk of change. And notice the bit about repairs. This is a key distinction. We are talking about fixing a leaky faucet, not doing a total kitchen overhaul before your first tenant moves in. That initial work is a capital expense and it doesn't count here. But here's the kicker, and you really need to hear this. If you choose this path, you absolutely, positively must keep all your receipts, invoices, and bank statements as proof for a full 5 years. IRAS can ask to see them anytime in that window. No paperwork, no deduction. Feeling a little overwhelmed by the idea of 5 years of paperwork? Yeah, I don't blame you. Luckily, IRAS created an alternative. So let's check out path 2, the 15% shortcut. This is the magic number that makes life so much easier, 15%. It's the core of this whole shortcut method, and honestly, it's designed to save you a ton of hassle. So how does it work? Well, instead of tracking every little repair bill and fee, you just calculate 15% of your total gross rent for the year. Then you deduct that amount as a stand-in, a proxy if you will, for all those little operational costs. Simple as that. And this is the absolute best part of the deal. You take your gross rent, you subtract that flat 15%, and this is the key. You can still deduct the full actual amount of mortgage interest you paid on top of it all. So you get the simplicity of the 15% rule, but you don't lose out on that massive deduction from your housing loan. It's pretty great. Okay, let's make this real with some numbers. Meet Mr. X. He earns $48,000 a year in gross rent. Let's say his actual small expenses for things like repairs and agent fees add up to $7,000. But if he uses the shortcut, 15% of his rent is $7,200. You can see right there in the table, his final taxable income is $200 lower. So in this case, the easier path actually saved him money. And Mr. X's example really boils it down to the one question you have to ask yourself. Which path is right for me? Am I going to track every penny, or am I going to take this shortcut? The answer, as always, comes down to doing the math for your own specific situation. Now, before you decide, there are a few important rules of the road. The good news, you can switch methods every single year. The catch, if you own more than one residential property, you have to use the same method for all of them in that tax year. Also, and this is important, that 15% shortcut is only for residential properties, not commercial ones. And fun fact, even non-resident landlords can use it. Alright, we've covered the right ways to do things. Now let's spend a minute on what can go wrong. Honestly, understanding the common mistakes is probably the best way to make sure you don't make them yourself. On the reporting side of things, a classic mistake is forgetting that rent for furniture also has to be declared. A huge trap for co-owners is just splitting the income 50-50 when the legal ownership might be 70-30. You have to follow the legal share, period. And of course, if you chose path 1, not keeping those records for 5 years is going to get you in some serious hot water, and the expense side is just full of potential errors. A really common one is trying to claim costs for when the unit is empty. You can only do that if you can prove you are actively trying to find a new tenant. And we said it before, but it's so critical, claiming that first big renovation is an absolute no-no. That's a capital improvement. The golden rule is this: an expense is only deductible if you spent the money while you were earning rental income, or at least trying to. So what happens if you do make one of these mistakes? Well, the penalties can be pretty steep, but the system isn't just about punishment. IRAS also gives you a clear path to make things right and get some peace of mind. Listen to this. Even if it was a totally honest mistake with no intention of cheating on your taxes, the penalty can be up to 200% of the tax you underpaid. That is a serious number, and is a very powerful reason to get your reporting right the first time. But there is a safety net here. If you suddenly realize you messed up on a previous year's filing, you can come forward. It's called the IRAS Voluntary Disclosure Programme, and it encourages people to correct their own mistakes. If you do this, you'll likely face much smaller penalties, giving you a clear way to get everything back in order. So there you have it. You know what counts as income, you know your two paths for expenses, you know the common traps to avoid, and you know how to fix a mistake. The ball is now in your court. Armed with all this info, what's your game plan for the next tax year? Are you going to be the meticulous record keeper, or are you going to take that convenient shortcut? The choice is yours. If you own a Singapore rental property and are not sure you are filing correctly, WhatsApp me at +65 9750 1055. I am Keith Tan from ERA Realty Network. Let me help you get this right.